Hello and welcome to Market Domination. I'm Allie Canal, live from our New York City headquarters and in for Josh Lipton. There's just an hour to go until the closing bell, and stocks, well, they're not doing so hot. You have the Dow leading the way lower, down roughly 0.8% or just over 360 points. The S&P 500 and the Nasdaq both down roughly 0.5%. Let's welcome in Jared Blickery joining us now to break down the headlines. And Jared, what are you seeing in markets today, this first trading day of December?
Kind of an unusual day. Now, some of this has to do with perhaps the Bank of Japan. So a long ways away, the Bank of Japan hints that they're going to raise their interest rates. And in sympathy, we have U.S. rates rising now. And I'll get to the Dow Jones in a second. Just want to show you the 10-year is up 8 basis points to 4.09%. The 30-year up a similar amount to 4.74%. Meanwhile, the U.S. dollar index, it was down more, now it's down a little bit less. You could almost consider that break even. So the effects of overseas action kind of being paired here. And if you take a look at what's happened with the Dow here, we are at the lows of the session. So there might be some underlying weakness here. NASDAQ, you can see, almost tried to break positive around the noon hour, 1 p.m. hour. Wasn't able to do that. S&P 500 hasn't come back to its lows just yet, but it's on the way down. And the Russell 2000, the small caps, those are the big underperformer today. That is down 1%. So the smaller guys have been outperforming recently. That would be the last 5 days, but definitely not today. So a little bit of a reversal of fortune. But as I said, this is a month of December. We expect lower liquidity, lower volumes, and this might just be a one-off. So let's not get too riled up over it. Nevertheless, we got to assess some of the damage here as well as some of the gains. Energy, looking at some greens today. It's the only sector up more than 1%. Everything else here in the green kind of treading water. Materials, staples, consumer discretionary. Tech just trading a little bit to the downside. Biggest loser is utilities. That is very interest rate sensitive. So not surprising to see utilities down as interest rates are rocketing higher here. XLV's healthcare, that's also down more than 1%, as are industrials and real estate. Now let's show you what's happening inside the tech-heavy NASDAQ 100. You can see a little bit of green here. Nvidia, Apple, each up about 1%, but also a lot of red. Broadcom standing out, that's down about 4% today. And if I shift over to the semiconductors, you're going to see, well, we got some big red spots here. Taiwan Semi also down about 1%. There are some green names like Marvell up 3%, NXPI up 2%. But here, look at software, another picture that's really dominated by some reddish inclinations. Also, here I'm going to close here. Leaders, we have China, that is outperforming today. Small oil, regional banks, retail, not doing tremendously great, but they are in the green here. To the downside, crypto really taking it on the chin. That Bitcoin proxy, that is down about 6%. Then biotech and transportation, aerospace and defense rather, and ARK Innovation Fund, those are also down more than 2%. So really kind of a risk-off day to start December, but we don't want to read too much into it just yet.
And that's right, Jared. But hopefully we get a little more green than red as we head into the end of the month and hopefully get that Santa Claus rally. Thanks so much. Well, Bitcoin is kicking off December under pressure, trading just around $85,000 a coin. That's a sharp reversal from its Black Friday peak above $92,000. For more, we're bringing in Yahoo Finance senior markets reporter Inez Ferre. And Inez, it's just been a pretty brutal stretch for crypto and Bitcoin in particular. We're seeing Bitcoin, the world's largest cryptocurrency, down around 9% now since the start of the year.
Yeah, Allie, and that bounce that we saw last week, it did not follow through. There was some resistance around the 92,000 level, and now we're seeing it down to 85,000, as you just noted. This comes after Bitcoin ETFs posted their worst outflow, monthly outflows on record, their second worst, that is. With respect to the Japanese yen and concerns over the Japanese yen, this may be what has sparked some of the sell-off that we saw coming into today, where we are now seeing Bitcoin down more than 7%. The last time some strategists have been pointing out that this concern over the Japanese yen happened was in August 2024. You saw Bitcoin prices plunging 18% over a span of just days. And then a couple months later, it recovered to new highs. But we'll have to see what happens here because there are strategists that are saying that Bitcoin is still there are still needs to be signs of a bottoming here when it comes to Bitcoin and that 81,000 level that we saw last month. Any type of macro shocks can send the cryptocurrency and others with it lower. There is one strategist that has been pointing out a range of anywhere between 70 and 100,000 range until the end of this year, and then for next year it'll be different. But looking at crypto stocks as well, Allie, these have just been hammered today. And if we just take a look at Coinbase, that is down. You've got Strategy that's down, Circle that's down. Strategy off the lows of the session. There's been some concerns that if Bitcoin goes much lower, then Strategy would need to sell some of its Bitcoin. But today the company announced that a reserve fund, a US dollar fund of $1.44 billion, that would go to fund any future dividend and also interest payments. So that should give them cover for about 21 months during this sort of Bitcoin volatility. And that should ease concerns, investor concerns about that. Now, they did update their full year forecast, so it now ranges from a net income, the possibility of a net income loss to a net income profit. That's just because of this range of sort of volatility out there when it comes to crypto. But Bernstein analysts are noting that really concerns about Strategy are overblown. They don't see these issues with Strategy. They're saying that these are overstated and there's no real material risk here. They're saying that these companies are fundamentally sound.
Yeah, and as we'll be digging more into the moves that we're seeing across the crypto space, along with some of those companies that you were mentioning, like Strategy. Thank you so much. Well, stocks are kicking off the final month of the year on a cautious note as investors digest holiday spending, a pullback in Bitcoin, and the next steps for the Federal Reserve. Our next guest saying that mid-cap stocks represent compelling value for patient investors. Joining me now is Josh Wine, portfolio manager for the Hennessy Cornerstone Midcap 30 Fund. And Josh, your first trading day of December, last month of the year, and things could be better. How do you view this latest bout of volatility? Is this just a late stage wobble or perhaps the start of something else going on in this market?
Yeah, it's good to be with you, Allie. It's a good question. So about a week ago, the market was pricing in just under a 30% chance of a rate hike, and it's steadily moved higher over the last week, and we're now sitting at basically a fully priced in rate cut, rather. I'm sorry, I think I said rate hike. So it's kind of selling the news. I think now that we see that a cut's coming, people are moving on to the next thing. I mean, this month is kind of an odd month, as your colleague mentioned, with tax loss selling and lack of liquidity and all of that. But I don't attribute much to the day's move, but it's certainly been interesting.
An odd month, but it's really been an odd year. We kicked things off with the DeepSeek scare, then we had the tariff surprise, and we had that sort of V-shaped recovery through the summer. Now, as we head into the end of the year, there's been a lot of talk of whether or not we're actually going to see that Santa Claus rally, whether or not the seasonal strength that investors are used to this time of year will emerge once again. Do you think Santa is going to show up at the end of 2025?
I don't know. I think he came early and spent the first 11 months giving people gifts. I think that earnings season's over now, basically, and it was a great earnings season for the S&P. So there's a little bit of a vacuum now, and we're not getting that kind of confirmation of all this good stuff that's going on. And I'd point out to margin expansion. The revenues were up about 8% for the market, and earnings about 13%. So that's a great story. That and the idea of rate cuts has gotten the market moving higher. I think from here on out, I think it's both a hope and a belief that there will be some kind of a rotation toward smaller and mid-cap stocks. They've certainly lagged this year and prior years, and the valuation story is certainly compelling.
And let's talk about that, because you said the market may be expensive, but stocks are not. So where are you finding value right now as we continue to track this rotation and the broadening out of this market beyond just those Mag 7 players?
Yeah, the market, the S&P as a proxy for the market at 25 times earnings, the average stock in the S&P is at about 18 times earnings. So that kind of is the backdrop. I think, though, that looking at mid caps at also about 18 times earnings is a little bit more interesting. As mentioned, there's this hope of a reversion of the mean, and that is a thing. It hasn't, we've been calling for that for a while, and one day we'll be right. But I would also just point out to M&A, we're hopefully beyond dealing with tariffs. And now I think corporations can look toward, M&A activity now that that fog has lifted, hopefully. And so, yeah, I think there's been M&A activity, an elevated amount recently, but it's not what I think we would have expected at this point in the year with the administration. Certainly very permissive in that regard.
So maybe more catalyst when it comes to M&A. And I know you mentioned Fed rate cuts, this continuation of easing. I mean, how much does the broadening trade rely on that? And is the market maybe more vulnerable if we don't see the number of cuts materialize next year?
I don't think the market's too vulnerable if we don't get the right number of cuts. I think that certainly small and mid-cap stocks, to be sure, will benefit from what's expected to be about 3 to 4 cuts by the end of next year. Anything above that, if we start looking at 5 cuts, that's certainly bullish. I think for the market and large cap and tech in general, I think it's just execution. I mean, it's growth. You mentioned DeepSeek. That was a big moment for a few days where we thought, oh no, NVIDIA has a competitor. And I think the jury's still out as to whether that's really a competitor or what the real story is there. But there will obviously be competition for NVIDIA, for AMD, for all these names that we talk about a lot. But I think, the opportunity's there and the market will have to get used to that. So I think the rate cut story is certainly at this point more a mid-cap catalyst than it is a large cap.
And when you're talking about mid-cap versus large cap, really throughout the course of this year, we've seen this K-shaped stock market. And at the same time, we're also experiencing a K-shaped economy where those higher income consumers are really propping up economic growth. How are you viewing the consumer right now, especially as we're starting to get more of that data back due to the end of the government shutdown? But we still have this mixed picture where consumer confidence is low, inflation's still sticky, and the job market cooling as well.
Yeah, it's a great question because you see a lot about auto delinquencies, and certainly that's the first bill a lot of people pay just because it's their means of getting to work, and it's for better or worse such a crucial thing for someone to have. But at the same time, we've seen great Black Friday numbers, and retail sales seems to be off to a good start for the holiday. I guess the inconvenient truth is that I think someone put it better, but 10 people go into a store, and if 9 walk out not having bought anything, all that matters is that one person did. And that speaks to the K-shaped economy that people are talking about. And it's too bad, but I think that is the reality. I mean, there's certainly spending on essentials, and certainly Christmas brings out the spender in everyone. But I think beyond that, there have been encouraging signs in the luxury sector, which I think is surprising. But yeah, I just think that you don't need everyone to be participating to have a great, consumer backdrop, which, is just the way it is.
Mm-hmm. And Josh, a quick one before you go. What's the most underappreciated pocket of the market right now, whether it be a sector or a specific stock that you have your eye on?
Yeah, I think the most underappreciated, maybe industrials. So in our Hennessy Cornerstone Midcap 30 fund, names like Leidos Holdings, which is a government contractor, and Jacobs Solutions, trying to search for that name. Jacobs building data centers and doing, electrical grid work and kind of supporting the efforts of advanced manufacturing and life sciences. I think names like that just don't get talked about. They are tangential perhaps to AI, but, in the case of Jacobs, certainly very supportive of it. And so whoever the winner is in AI, there will be multiple players building these data centers and the infrastructure to support them.
All right, Josh Wine, thank you so much. Definitely a lot to keep track of as we head towards the end of the year. Appreciate it.
Thanks, Allie.
Well, coming up on Market Domination, questions around the health of the AI trade loom over the broader market. We're digging into the action, especially after a slew of new deals were just announced today. Plus, President Trump says he knows who he'll pick to be the next Fed chair. Get to know one of the top candidates, Kevin Hassett, later on in this hour. A busy day for deal making in the AI space. OpenAI adding to its list of circular deals. The ChatGPT maker now taking an ownership stake in Thrive Holdings, which is a company that was launched by one of OpenAI's investors. OpenAI also striking a deal to be one of Accenture's primary AI partners. And NVIDIA also pulling its weight in AI deals, announcing Monday that it's invested $2 billion in Synopsys. So as the AI train chugs along, we're taking a look at where the deal making and investments could lead to with Bloomberg Intelligence senior semiconductor analyst Kujan Shobani. And Kujan, we talk a lot about whether or not we're in an AI bubble, valuation, one part of that story, but also the circular investments that we were just discussing. So how do you view that? Is that just the way these things have to go for now, or does that concern you at all when we look at the vitality, I guess you could say, of the continuation of AI?
Well, so far, when we look at fundamentals in 2026 with hyperscaler capex projection to top $500 billion, and remember, these are the customers which have surplus balance sheet cash, so there is no concern around them being able to spend this money or not. The fundamental view suggests there is no slowdown in demand and spending for AI chips, especially when it comes to the GPU and AI ASIC chips, at least in 2026, and the visibility into first half 2027. A few key items we want to highlight for 2026. We again think NVIDIA will likely stay dominant wallet share taker of this spending, but second half 2026 will be key inflection point for other players. One, AMD, this is when their first server rack level solutions will start ramping in data centers. And along with that, we are expecting to see significant AI-based accelerator deployments in second half 26 from both Google and AWS. And this is the first time for external customers. So a lot of eyes will be focused on these ramps.
And it's interesting that you talk about sort of the different paths that these various companies could take, because even looking at the Max 7 players right now, there is clear dispersion. They're not necessarily moving in lockstep anymore. So what does that signal about where we are in this current AI cycle?
Yeah, it's just there are more vectors driving the spend now. You have your sort of the Max 7 or the largest hyperscale cloud service providers, which have a very significant and validated demand and spending capabilities. And then you have these new emerging hyperscalers, the one like OpenAI, right? So a lot of concerns around this revolving financing or recycling revenue and deals are coming from that emerging portion of the hyperscaler, which again is becoming large, so it will be a significant impact. But that impact, if happens to show up, will not be at least in the next year and a year and a half. So it's a more outward pushed concern at this point.
And everyone talks about NVIDIA. OpenAI has clearly been part of the investor vernacular recently, but you've been highlighting Marvell, Broadcom as some underappreciated winners. So what are investors missing?
Yeah, like I mentioned, second half will be a key inflection point in terms of unit volumes. We have seen the couple of deals, right? Namely the Google Anthropic and the AWS Anthropic deals, and now some more outlook for more such deals are coming in. So when these large hyperscaler who they have their own AI ASICs are now trying to supply that to the external market, sort of competing with NVIDIA, the two companies that gain the most are the Broadcom and Marvell, where the valuations and the fundamental are not fully priced in yet. So we see some opportunities in these two names going forward.
And what do you think has been priced in so far? You've been talking a lot about the 2026 inflection point. Considering where valuations are today, especially among some of those mega cap names, how much is priced in versus what should investors expect to continue to drive some of that growth?
Yeah, so when we look at multiples for the overall AI names, especially large names, they don't seem to be at exorbitantly high levels, but we do think they have priced in the strong growth in 2026 and at least some portion of first half 27 that I mentioned. So at this point, it will come down to execution on the and the concerns are not more towards the spending side, but more on the supply side. Can these new programs like the AMD server rack ramp and the ASIC programs, can they execute? Will they run into some hiccups? And can the end infrastructure, which is the data center infrastructure, keep coming up at the same pace? Because remember, there's more bottlenecks now when it comes to spending, when it comes to power that these data centers need.
And just to keep the theme of the bubble conversation, I was reading a note from Bank of America, and they call this more of an air pocket supported by earnings and fundamentals. How would you describe where we're currently at in the AI cycle?
I think I would agree with that, given what's happening in the macro, the interest rate volatility, and especially this time of the year and the performance we have seen. I think it doesn't seem like it does seem like an air pocket or sort of a hiccup on the way. Again, if the execution on the 26 numbers and first half 26 continue as projected, we don't see significant risk to valuation at this point. However, there has been this expectation set up of every quarter to be a beat and raise. So even a small timing hiccup, which could occur in one of these large ramps, could drive a bit of a volatility in terms of valuation.
And I know you're bullish on the AI accelerators. What specific names within that category should investors be watching?
I think Nvidia and Broadcom remain the top of the mind. But like I mentioned, a few other names that could be interesting from time to time would be Marvell and Astera Labs.
All right, Kujan, thank you so much. Certainly so much to continue to watch in the AI tech space. Appreciate it. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins us now for a look at Disney, Toast, and Bath & Body Works. Starting with Disney, the company sees the debut of Zootopia 2 bringing in a box office win, and Toast getting a lift at BNP Paribas, the firm upgrading the stock from neutral to outperform, noting room for growth. But Brooke, let's start with Disney first, because Zootopia 2 crushing the box office.
Yep, as expected.
As expected, but it really was that global growth and really the strength that we saw from China, which for Disney, we haven't seen in quite some time. It's actually been a big shift throughout Hollywood at large. You can't really rely on China the way you could in the past, but clearly Zootopia 2 making a splash there, and also just underscores how family-friendly movies, they're continuing to crush it at the box office.
Yeah, and this is a really important win that Disney really needed right now. And we see the pop in the stock about 2% today, pulling back from a bit higher of a gain earlier today. But we know that this was the second biggest, not the first, but the second biggest open here in North America. Over the weekend, Zootopia 2 grossed $156 million in North America alone. Now, globally, we saw about $556 million in global ticket sales, but this was actually the second biggest open here in North America. Moana 2 last year brought in about $225 million in 2024, and then before that, Frozen 2 had the number one spot. And so it's just interesting to see what exactly will get consumers out willing to spend on these pretty expensive movie tickets, and that's certainly leading to some optimism on the street.
Yeah, you talk about the second biggest Hollywood opening in China ever. That's behind only Avengers Endgame, and we know how popular the Avengers franchise is in China, and the original Zootopia also was a major hit when it debuted in China. So a big win for Disney there and boosting some shares this morning. But I tease this a little bit. Let's talk about Toast getting a lift at BNP Paribas, the firm upgrading the stock from neutral to outperform, noting room for growth. Now, the main catalyst behind the upgrade is that U.S. restaurant ecosystem and really the ability to grow alongside Square, which we know is a big competitor for Toast.
Yeah, and year to date, the stock is down nearly 5%. Over the past year, the stock is down more than 20%. And so clearly, this definitely sends some upward optimism on the street of where exactly Toast stands within this competition. They did point out in the note that Toast leadership is intact, saying that competition and point of sale software for restaurants is accelerating. Of course, others getting into the fold here as well. But they said that the Toast still has plenty of room to go, especially outside of the U.S. alone. And that'll be a key business for them to go as they seek elsewhere, seek global opportunity there. And that's where we're seeing some momentum in their, as we make our way towards the trading session.
Now, they did say that Square could be more of a threat over the long term. Square, of course, is owned by Block. But for now, there's room for both of these players to continue to grow within their respective markets. So we'll have to continue to see. $40 price target there implies around 15% upside. And lastly, Bath & Body Works seeing signals of upbeat sales for Black Friday. And that was driven by a few things: aggressive promotions, solid foot traffic, also strong performance among teens and value-driven demographics, which I thought was interesting considering we keep talking about the K-shaped economy and the spending behaviors of the U.S. consumer.
And Bath & Body Works is a company that has not been doing well lately. They've really been struggling to get those younger consumers in the store. They even went out to college campuses to try to get young consumers' attention. But what won this past weekend was buy 3, get this, get 4 promotion. That did really well for the company. This led to their 5th straight day of gains as far as the stock price goes, now up around 8% as we make our way towards the close. And really, this is what the company needed after it had that lackluster third quarter report. They also had a not so good outlook for the fourth quarter. And so to see the strong momentum as we make our way towards year end was really what the street has been looking at, especially after some deals that they had announced earlier this year, as well as partnerships with companies even like Disney, like we had discussed, really fell short of the street's expectations. We know we have a new CEO there. Daniel Heath took the helm back in May of 2025 of this year. And really that momentum is just a wait and see approach now.
Buy 3, get 4. I like that.
I know. When I read that, I was like, are we sure about that?
Sometimes more is more when you're shopping. Right. But yes, appreciate all those insights. Brooke, we'll have you back here to talk a lot more retail movers. But coming up, a look at the health of the U.S. and global economies in 2026, plus a look at what to expect and the implications of the rise of AI. President Trump saying Sunday he knows who he wants to pick as the next chair of the Federal Reserve. He didn't give away the name, but prediction markets are betting on Kevin Hassett. Polymarket data shows he's sitting at 78%. Fed correspondent Jennifer Schomburger has a closer look at Kevin Hassett's take on the Federal Reserve.
National Economic Council Director Kevin Hassett is seen as one of the frontrunners to be the next chairman of the Federal Reserve. He has a close relationship with President Trump, serving as his economic advisor. He also served during the first presidential term for Donald Trump. Hassett told me in an interview recently that he puts a high priority on Fed independence, sound money policies, and getting interest rates aligned with economic conditions. He told me he thinks the Fed has made some bad policy decisions that at times look to be partisan. He criticized the Fed for assuming that a spike in inflation around the pandemic and Biden-era stimulus checks was temporary. He also singled out that the Fed started raising rates when tax cuts were passed during Trump's first term, then cut rates right before the 2024 presidential election.
I think that there's a lot of house cleaning needs to happen at the Federal Reserve, and I'm confident that anyone the president chooses will get to work and try to fix it and make the Fed independent again.
Hassett shares President Trump's views that interest rates should be a lot lower than current levels. He says it would be a mistake for the Fed not to cut rates in December, given that he believes the government shutdown dented growth in the fourth quarter. Julie?
Thanks so much, Jennifer. Well, now we're looking at the impact of AI on the economy. A new estimate showing that technology will help support weak growth around the world to start the new year. S&P Global Ratings Global Chief Economist Paul Grunwald sat down with Julie Hyman on Market Catalysts.
And so after the tariffs, everyone was marking down growth. We didn't have a recession, but we had a borderline recession. But the tariffs were not as bad as we thought. So numerically, they're lower. There was very little retaliation to the U.S., and then it's taken time to pass through. So those effects were moderate, but now we've got these tailwinds. We've got AI in the data centers, we've got lower energy prices, and we've got pretty easy financial conditions. So now we're kind of back up to 2 at the end of the year, which is potential for the U.S., and we did the U again this year.
And how significant is AI as a percentage of that?
We don't have a direct measure, but we think it's at least half an extra percentage point of growth on an annual basis. And then the other way to look at it, something like 80% of domestic spending in the first part of the year was AI and data centers, which is huge, right? So if you scrape that out, you get a labor market that's pretty weak, an expansion that's pretty narrow. So this is going to be a nice tailwind to growth for the U.S. for probably the next couple of years.
I mean, on the flip side, when we talk about tariffs, I just talked to someone from ISM, the Institute for Supply Management. Yeah. We got their manufacturing numbers today. What was it? 10th straight month of contraction in manufacturing. Now, I know manufacturing is not the largest part of the U.S. economy by far, but still, these tariffs are something that are designed, at least in theory, to help that sector. It hasn't.
Yeah, we're not seeing the reshoring that was originally thought, but we're losing employment in manufacturing, we're losing employment in government, we're losing employment in tech. So aside from the data centers that we just talked about, there's really not much going on. But the manufacturing, we've basically taxed ourselves, right? We're taxing imports. Either American firms or American consumers are paying that. We still have the policy unpredictability overhanging everything, and that's putting a damper on a lot of things, including manufacturing output.
And something that we've talked talked about in the past with this so-called K-shaped economy, or whatever you want to call it, the gap in spending, is that from an economics point of view, like, it's fine if the wealthiest Americans are spending enough to keep the economy afloat.
But we've been pointing out this narrowness argument for a couple of quarters. So the labor market strength is narrow, the demand story is narrow, the manufacturing story is narrow, and the consumer spending story is relatively narrow. So the top 10% are roughly sort of 40-50% of spending. So we're not getting the broad-based recovery, and that's probably not sustainable over the longer term. But short term, that kind of juices up the growth rate. So that's again masking some of this weakness.
Right. I mean, do we expect any broadening? And if so, what's going to be the catalyst for it? Is it going to be, for example, the tax bill and some changes?
The tax bill will help. Lower energy bills will help. But also the data centers are kind of spreading out across the country. They were originally concentrated right outside of D.C. and Loudoun County, Virginia. But now they're kind of everywhere. So we might get a multi-year boost for this smaller stuff. But, manufacturing coming back and building out the middle class, kind of 1950s style, that's definitely not something we see in the cards coming back.
You've mentioned a couple times energy costs being lower as being a tailwind. Energy costs, though, when you're talking about gasoline, are lower, but they're not lower when you're talking about energy, the power coming into your home. To be sure, electricity costs are not lower, and that's something that's really become this big talking point in the so-called affordability crisis, is that cost of electricity. Right. How do you think about that?
Electricity demand has been flat for many, many years, and now it's starting to pick up again. We've talked about data centers several times already, but you've got examples of communities where some ginormous data centers being built, and those things need a lot of power, and we've got a big, sort of upward slope now for energy demand, electricity demand in the U.S., and that's pushing up utility prices. And some people are saying, hey, my bills are going up, and this data center down the road is pushing the costs higher. So we get back to these distributional issues we've been talking about for the last couple of decades, and this is just another example of that. These things are, going to generate some output and, generate AI, which is supposed to make our lives better eventually. But in the short term, they're pushing up electricity costs for these local communities.
So we've been talking all about the U.S. Globally, what do we need to pay attention to? Are we going to see sort of global growth, modest global growth?
Yeah, I mean, it looks okay. I mean, Europe and parts of Asia are actually benefiting from this digital infrastructure build out in the U.S. So you see it in Ireland. You also see it in Taiwan, in Malaysia, and in South Korea. So we're getting some exports of high-end sort of tech stuff from those guys into the U.S. Europe's got a little bit of a boost. This is Europe, so we have to scale our expectations appropriately. But with the German debt brake being released, we think growth could go kind of 1.25 to 1.5 on infrastructure and defense. China's a tricky story because we know they are world beaters in kind of clean tech, right? Solar, wind, electric vehicles, batteries, but they're still having a property overhang and kind of 4.5-ish growth. So we're going into a reasonably good year in 2026. It's not a great year, but we've got the US, kind of 2-ish, Europe 1.5, Asia 4. EMs are actually benefiting from those lower energy and gasoline prices. That's a huge part of their consumption basket. So that's a little tailwind for them as well.
And Paul, I'm curious, beyond next year, if you look into your crystal ball and how this AI story is going to play out from a labor force transformation aspect. I know it feels a little early to know, but what are you going to be watching and how are you thinking about that?
Well, I think on impact, the effect's going to be negative, right? We're already seeing some layoffs. The tech sector's not generating employment in the U.S. It is in Europe, by the way, which is kind of interesting. But the hope and the aspiration is we're going to get, new technologies and new ways of doing things. So on impact, we have negative impact on labor supply or labor demand, but then over time that kind of goes up and we get a sort of a labor renaissance and we get productivity and all that kind of stuff. That's baked into a lot of the pricing, so that's something to watch in the next couple of years. But that's the view now. It's still early days, but maybe next year we get a bit more clarity on both the macro payoff on the productivity and also the financial payoff on the earnings. Both of those have to come through.
Well, coming up, e-commerce stocks are moving after a busy holiday shopping weekend. We'll wrap what the spending says about the health of the consumer and what's in store for the rest of the year when we return with more market domination. Michael Burry, the investor known for predicting the housing meltdown, is taking aim at Tesla. In his new Substack, Burry details his critique of the EV maker's valuation. Yahoo Finance's Pras Subramanian joins us now with the details. So Pras, Michael Burry saying Tesla is overvalued. He slammed Musk's pay package.
Yeah.
What is the overarching theme to this thesis here from Burry?
Well, I think it's just attacking another richly valued stock, like you said, right? He said that, in a post about the tragic algebra of stock compensation, guess who came up, right? Tesla, right? So he said, quote, Tesla's market cap is ridiculously overvalued today and has been for a long time. And he said that Musk's pay package will continue to further dilute the stock, right? And in addition, he said that, as an aside, the Elon cult was all in on electric cars until competition showed up, then all in on autonomous driving until competition showed up, and now is all in on robots until competition showed up. So he's also attacking just the bull case of Tesla. And we've seen the last 2 weeks, some prominent analysts have come out very bullish on the AI, the autonomous, and even the Optimus robot stuff. So Burry pouring cold water on that. He was also in the past been bearish on Tesla too. So this is nothing new. And we saw Jim Chanos too, also in the past, was bearish on Tesla. But they're also compiling in on some big high-flying AI stocks too.
And to that point, Burry taking out short positions on both NVIDIA, Palantir. So you think he could be speaking to kind of this idea that tech is overvalued more broadly across the space?
Yeah, and I think the names connected to the AI space in particular, talking about circular vendor funding, CapEx build out. He's all concerned about these things that we've heard a lot of people talk about. With regards to Tesla, it's a car company, right? So it has a money-making
Unless you
component.
ask Jan Ives, he says it's offensive to call it a car company.
Yeah, right. I mean, in that respect, yeah, when it comes to like sub 10 PE ratio, right? But I think it's more about, like you said, it's a tech skepticism, CapEx skepticism, that sort of thing. I can't say the word skepticism, by the way, but I'll try.
I know, say it 3 times fast. But when we're talking about Tesla, it's not just a valuation debate. And we got some new headlines that they're starting to lose share in several key European markets while competitors just continue to gain. And we know that's been the story in China. But do you think this is more of a demand problem, a competition problem? And where does Tesla really go from here?
I think it's a mix. I think it's equally a mix of competition, but also demand. We're talking about falling sales in November in France, Sweden, Denmark, and the Netherlands. This follows a massive tumble in October where the entire European region, their report numbers about a month later, saw a 50% slide in sales, right? So it can't just be just the competition alone or demand alone. The Musk factor, of course, his sort of dwindling reputation there, his perception of the brand is falling. So that's a big mix there. But like you said, if they can solve FSD and AI and autonomous and those technologies, that's a big boost for them, right? People might otherwise say, you know what, I'm going to give them a shot because of the fact I can drive to work, and I can sit here in the car driving to work, right? So that's the bet, and the bulls hope that compensates or overcompensates for competition, and also the Musk factor.
I feel like when it comes to Tesla, no one's in the middle. The bulls are passionate, the bears are passionate, and I'm taking
I'm in the middle. I'm in the middle.
You're in the middle, yes. You're a reporter, you're a journalist. I'm taking a look at a year-to-date stock chart, though. It's a bumpy ride, man. I mean, you need to drive that Tesla on a roller coaster to kind of show you what the moves of the stock are.
This
Crazy.
is a tough ride to be on, right?
Yes.
I mean, when do you have conviction to say, I'm going to buy at that point in March, or I'm going to potentially sell, take some money at the top in November, right? That's a tough call. Yeah.
We'll see who gets off of the ride at the end, the Bulls or the Bears. Pras, thank you so much, as always. Appreciate it. Well, we're in the thick of a busy holiday shopping season with consumers leaning heavily on mobile, AI-assisted shopping, and buy now, pay later options. For more, we're bringing in Scott Devitt, Managing Director of Equity Research at Wedbush. And Scott, I first want to talk about the headlines that we got this morning for Shopify. Stock is down around 5%. We had outages that were reported across the country, across the globe. It really spiked around 11 a.m. Eastern this morning. Seems to have teetered off a bit according to Down Detector, but it's Cyber Monday. Do you think this is going to impact some of those Cyber Monday sales expectations? Because it was expected to be strong.
Certainly not good marketing PR. It's mostly a merchant access challenge. So the sites that Shopify powers are still functioning. It's just that merchants can't access and ship product, and so to the extent that it lasts an extended period of time, it would be problematic. I think it'll be probably a rounding error in the interim to the extent that this gets resolved today and items can be shipped.
All right, so hopefully not too bad of a hit when it comes to Cyber Monday. And when we take a look a couple days ago to Black Friday, those sales were pretty strong. And there was a lot of fear heading into the holiday shopping season that the consumer was going to pull back. We recently saw retail sales miss expectations. Consumer confidence has been low. Put it all together, what's your takeaway when it comes to the state of the U.S. consumer?
So the letter K is appropriate. I think it's used a lot. And I think that overall, e-commerce trends are relatively strong, 6 to 9% for the holiday. The higher income consumers doing better, but I think overall trends are actually pretty positive. If you want to keep it simple in retail, there's an endless number of retailers in the world, but just focusing on Amazon and Walmart, probably takes care of the vast majority of investor needs. And then when you layer in companies like Apple and Tesla, now that Tesla cars drive themselves, there's some nice high-end gifts that can be purchased as well, and investment ideas on more product-based companies, as well. But that's kind of simple. And otherwise, you're dealing with trends and things that change every year in and out. And so we try to keep it simple with retail ideas, and those are probably 4 that are the most interesting.
Mm-hmm. So keep it simple, and it's hard to keep it simple when there's so many different signals of where you can look at to tell you what's going on with the consumer, whether it be earnings, the hard data, the soft data, the survey expectations. Is there one thing that you look at that gives you more confidence than maybe some of the other data points?
So, we focus on the e-commerce names. And so to the extent that e-commerce trends continue to be healthy, which they are, so growing in the upper single digits, that's an indication. You have to find the companies that are gaining share within that mix. Of course, Shopify, with the exception of the outage today, is gaining a tremendous share, growing at about 3 times the rate of the industry. Amazon, given its size, scale, ability to ship so close to the holiday, tends to be a huge beneficiary around the holidays as well. And then other names like eBay and Etsy, they're doing well, but for different reasons. And sorry for that phone call, but they're doing well for other reasons. But they're not, I think, particularly levered to the holiday the way that the traditional retailers are.
Do you think they could do well beyond the holiday season, or are there other things at play that maybe they're struggling to catch up to some of those bigger names that you mentioned?
So eBay's had a tremendous turnaround, and they're doing well as a company. But eBay and Etsy are lower single-digit growth type businesses now. And so I think when you're looking for compounding businesses and growth, you want companies that are really gaining market share, which is why I highlight Amazon most prominently, because of the valuation support that it has and the market share gaining trends that support that business. Shopify, although it's an expensive stock, is gaining a tremendous amount of share. And then Walmart, which we don't cover, but it's doing a very good job of managing its business and becoming a much more relevant company again. And
let's talk about some of those trends. We have buy now, pay later. We have AI assisted shopping. How are these trends impacting in the different ways that folks are shopping? And how does that correlate to some of the stocks and companies that are outperforming within this environment?
So for, buy now, pay later, it's an aspect that just creates another category of credit for consumers. So it's incrementally positive, but not significantly so. But another way for consumers to pay. And generationally, I think the younger generation is more transitioning to that type of model and away from credit cards. When you look more broadly in terms of agentic commerce as a driver of retail, it's early days, not even day one. I think in the coming year to 2, as we see how Gemini and ChatGPT begin to integrate those services into their platforms, and as well, the way that Amazon and eBay and Etsy integrate them directly into their platforms, it'll be a bigger driver of the business. But we're still very favorable on the companies that actually run marketplaces or sell goods and deliver them to consumers, and don't really think that ChatGPT and Gemini will be disruptive in the way that some investors are concerned.
You mentioned younger shoppers, and Deloitte had a new survey out saying that Gen Z shoppers are expected to slash their holiday spending budgets by an average of 34%, which was higher than a lot of other groups. When you look across the various demographics of shoppers out there, what are some of the trends that you're noticing, especially among those younger consumers?
Well, it's tough within that cohort to have consumer discretionary dollars to spend, given what's happened with inflation over the last decade. And so I think that generationally, it's a bigger question that needs to be asked. I think in terms of the way that wealth is being created among those that are older, and the way that wealth is passed down, that's going to help subsidize the younger generation. At least that's the way that it looks today. So when you look at that, the example of where the dollars are being spent, those that have assets because of the past 5 years, the gap between them and everyone else, including that younger generation that's just going through college today, it's as wide as it's ever been. And so it's okay from an aggregate standpoint because the dollars are still there to spend, but it's much more levered to those that have assets, which Gen Z don't yet have. And that's a problem when you look at it demographically, and you look at the generational spend dynamics and why Gen Z is lagging.
Yeah, we also know that new entrants into the job market, graduating college, they're actually having a very tough time finding a job. But then real quickly there, you mentioned the K-shaped economy. It's the latest buzzword. Obviously, what you were just talking about relates directly to this. In order for companies to be successful today, do the business models need to be, more levered to a K-shaped economy?
Well, I think you're seeing the companies that are levered to the top end of the K, if you will, are doing better, and that's going to continue to be the case unless something changes in terms of who has the money. And I don't see that happening near term. So you want to have companies that are levered to higher income consumers, and the names that I mentioned, I think increasingly Walmart's levered there. Amazon certainly is. Companies like Costco and Apple and Tesla are where you want to be because the dollars are there to spend. GDP is still growing. It's just coming from a smaller pool of consumers.
All right, Scott, I appreciate those insights. Thank you so much.
Thank you.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.